Welcome to the Deep Dive. I am your host, and I am incredibly excited to get into the weeds today.
And I am your resident expert for today's deep dive. Really looking forward to this one.
Yeah, usually when we talk about a medical diagnosis, there's this expectation of pure mechanical precision, like
Ah,
engineering, right? You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, well, there it is.
right. It's binary. It's either broken or not broken. We inherently crave that kind of visibility.
hmm
We want complex systems to be easily categorized into these neat little visual boxes.
Exactly. But then you step into something infinitely more complex, like neurodevelopment or systemic trauma or cellular metabolism, and suddenly that x-ray machine is completely useless.
Totally useless.
Right. You are looking at a diagnostic landscape that is just entirely murky. You can't just point to a single broken bone. You have to understand how 100 different invisible systems are all interacting at once.
And frankly, that is exactly the metaphor we need for the global economy right now. I mean, the old diagnostic tools, the traditional x-rays of how the world is supposed to work.
Like interest rates and shipping lanes.
Yeah, exactly. Interest rates, shipping lanes, software licenses, those legacy metrics are completely failing to capture the reality of what is actually happening beneath the surface. The legacy machinery just giving us bad readings.
And that is exactly what we are going to dissect today. We know you, the listener, the learner, want to cut through the noise. You want to understand the actual mechanics of what is shifting in the world without drowning in the raw data.
Right.
So to do that, we are zooming in on a highly specific, incredibly pivotal day, March 19th, 2026. This isn't just some random date. It is a day of profound, almost surreal contrasts that forces us to look at the world through two entirely different lenses.
Yeah, to really grasp the magnitude of March 19, 2026, we have to look at these two parallel tracks simultaneously. So track one is the physical world. It is fragile, and we are watching the active breakdown of physical systems.
Like energy supply chains and debt.
Exactly. Energy supply chains,
Yeah.
traditional sovereign debt mechanisms, legacy banking, that's track one. But then track two is the digital and biological world. And here, we are witnessing rapidly accelerating autonomous systems.
It's the exact opposite of the physical breakdown.
Completely. We're talking about AI agents taking over corporate workflows, digital commodities becoming legally recognized, quantum simulations solving atomic mysteries, and metabolic medicine just hitting massive clinical breakthroughs.
Okay, let's unpack this because we really have to start with the physical shock, the geopolitical catalyst. If we look at the reality on the ground on the morning of March 19th, the escalating conflict between Israel and Iran has moved way beyond proxy skirmishes.
Right, it's direct now.
Yeah, it has targeted the literal physical energy plumbing of the entire world. We are looking at massive missile strikes on Qatar's Ras Laffan industrial city, specifically the Pearl GTL plant, as well as several major Saudi energy sites.
Which is huge.
It is. And I want to pause right here because when people hear energy strike, they usually picture, a pipeline leaking in the desert. But the Pearl GTL plant is something entirely different.
Radically different.
Mhm.
So GTL stands for gas to liquids. And the Pearl facility in Qatar is literally the world's largest plant of its kind.
It's not just a drill site.
No, not at all. It doesn't just pump oil out of the ground. It uses a highly complex chemical procedure called the Fischer-Tropsch process.
Fischer-Tropsch, right?
Yeah. And it uses that to convert raw natural gas into incredibly pure, high-quality liquid hydrocarbon products, things like diesel and jet fuel. So it's not a well. It is a massive,
Yeah.
highly calibrated chemical refinery.
Right, which means you can't just patch it with a welding torch in an afternoon.
Precisely. The economic transmission mechanism here is just devastating. I mean, for months leading up to this, the global market was pricing in shipping delays.
Right, the whole Red Sea and Strait of Hormuz situation.
Exactly. The assumption was, okay, the Strait of Hormuz is getting dangerous, so ships will just take the long route around the Cape of Good Hope. Insurance premiums will spike, but it's manageable.
It's just a temporary logistical headache.
Right. But a direct strike on Ras Laffan, with widespread fires knocking out significant liquefied natural gas and GTL capacity, that represents lasting capacity destruction. It literally takes years to rebuild a Fischer-Tropsch reactor.
And then you layer on the fact that the Strait of Hormuz, which is right next door, carries roughly 20% of the world's global oil supply. You aren't just looking at a bottleneck anymore.
No, you're looking at a structural crater in global energy availability.
And the markets reacted violently. I mean, Brent crude soared to $111.72 a barrel, and WTI crude hit $97.25 almost instantly.
Which triggers an immediate psychological and mathematical cascade across the entire global economy.
But wait, let's actually do the math on the fail-safes here. Because we always hear politicians talk about the Strategic Petroleum Reserve, the SPR.
Right, the big salt caverns.
Yeah. We have these massive underground salt caverns in Louisiana and Texas full of emergency oil. The inventory sits at roughly 400 million barrels. So, if the market is panicking, why doesn't releasing that reserve immediately calms everything down? I mean, 400 million sounds like a massive number to me.
It sounds massive until you look at global consumption rates.
Mm-hmm.
You have to remember, the world consumes over 100 million barrels of oil every single day.
Wow. Every day.
Every single day. So if the Strait of Hormuz is severely bottlenecked and 20% of global supply just vanishes, that's roughly 20 million barrels a day gone.
Just off the market.
Exactly.
Mm-hmm.
So that 400 million barrel reserve, if you do the math, it provides exactly 20 days of coverage to plug that specific gap.
20 days, that's it.
That's it. Maybe 25 days if you stretch it with extreme rationing. The market looks at that 25-day hourglass, realizes the Pearl GTL plant will take 3 years to rebuild, and understands the math simply does not work.
And it isn't just about volume either, right? It's about the type of oil.
Oh, absolutely. That's a huge factor.
Because the SPR has a lot of what they call sour crude, which has high sulfur content. But a lot of the world's refineries are optimized for the sweet crude coming out of the Middle East. You can't just instantly swap them without damaging the refining equipment or severely slowing down the output of gasoline and diesel.
That's a really crucial point. The friction in the physical system is immense. You can't just substitute one liquid for another. And that fear immediately bleeds into the real economy.
It hits the consumer.
Instantly. Consumer sentiment, according to the University of Michigan data from early 2026, has plunged to 56.4 index point. That is deep, dark recessionary territory.
Oh.
Yeah, we are seeing a psychological environment highly reminiscent of the 1970s energy shocks. When the cost of simply putting diesel in a delivery truck or turning on the lights at a factory doubles overnight, it suffocates consumer spending and corporate margins simultaneously.
Which brings us to the people who are supposedly in charge of fixing this. The central banks. March 19 happens to fall right in the middle of Super Thursday.
Oh, Super Thursday, what a mess.
Yeah, it's this massive cluster of interest rate decisions from the world's most powerful money managers. And their reaction to this global energy fire is, well, complete paralysis.
Total deer in the headlights.
Exactly. They are locked in a defensive wait-and-see posture. The U.S. Federal Reserve, just the day prior, held rates at 3.50% to 3.75%. They effectively killed any lingering hopes for 2026 rate cuts.
We really have to look at the mechanics of why they are paralyzed. Because central banks essentially have one blunt tool to manage the economy, and that's the interest rate lever.
Right.
They use it as a brake or an accelerator. So when demand is too high and the economy is running hot, they raise rates to make borrowing expensive, which cools things down. When the economy is sluggish, they cut rates to make money cheap and stimulate growth.
But an energy shock completely breaks that lever, doesn't it?
Completely. Because an energy shock creates something called cost-push inflation, or stagflation. Prices are skyrocketing, not because people have too much money and are out buying too many things, but because the foundational cost of simply moving goods has exploded.
Right, the diesel for the delivery truck.
Exactly. So if the Fed raises rates to fight this oil-driven inflation, they are actively crushing businesses that are already suffocating from high energy costs, risking a severe, deep depression.
But if they cut rates?
If they cut rates to stimulate those struggling businesses, they make borrowing cheaper, which increases demand for limited goods, pouring absolute gasoline on the inflation fire.
So they literally do nothing. They hold the line and pray.
They hold the line. And we see this exact paralysis rippling globally. The Swiss National Bank, the SNB, held at 0.00%.
0%.
Yeah, zero. They have a really unique problem. When the world panics, investors flood into the Swiss francs because it's viewed as this ultimate, pristine, safe haven.
Right.
But that makes the franc incredibly strong against other currencies, which crushes Swiss exports because their goods suddenly become way too expensive for the rest of the world to buy. So the SNB is trapped trying to keep rates low enough to deter people from buying francs while simultaneously dealing with imported inflation.
And Sweden's Riksbank held at 1.75%, realizing that any certainty they had about inflation cooling off is just completely gone. But the most fascinating dynamic here to me is the Bank of Japan. They held at 0.75%.
Which is wild for them.
It is. Now, for anyone used to Western interest rates over the last few years, 0.75% sounds microscopic. I mean, my savings account pays more than that. But in Japan, that is a multi-decade high.
Yeah, Japan has been the great outlier of global macroeconomics for 30 years now.
Let's really dig into that because I think a lot of people listening might be confused by Japan's reaction here. Japan has been absolutely desperate for inflation since the 1990s.
Right. The lost decades.
Right. They've had decades of deflation where prices actually fall, which causes consumers to delay purchases because things will be cheaper tomorrow, which starves companies, which kills wages. So they've wanted prices to rise.
Desperately.
So if a Middle East energy shock brings massive inflation, why is the Bank of Japan acting so cautious? Why isn't the governor, Kazuo Ueda, popping champagne?
Because there is a massive difference between good inflation and bad inflation. What Japan spent 30 years trying to engineer was demand pull inflation. That's the good kind.
Okay, explain the difference.
Demand pull means your domestic economy is booming, companies are innovating, consumers feel rich, so they buy more things, and businesses can naturally raise prices and subsequently raise employee wages to match. It's a virtuous cycle.
But cost-push inflation, like what we're seeing now, is a vicious cycle.
Exactly. The cost of imported oil and liquefied natural gas is skyrocketing. And Japan imports almost all of its energy. They don't have domestic reserves.
Right.
This means the cost of living for the average Japanese citizen is going up dramatically, but their wages aren't keeping pace at all. The domestic companies aren't actually seeing higher demand. They're just paying way more for electricity.
So people are just getting poorer.
Yes. Governor Ueda stated clearly that the escalating Middle East conflict is clouding the outlook. They know this energy spike will ravage consumer spending, which will ironically push core CPI inflation below their 2% target before it surges again wildly. It makes real interest rates deeply negative, just eroding the purchasing power of the entire population.
But the vote to hold at 0.75% wasn't unanimous. There's a fascinating crack in the consensus here. A Bank of Japan board member named Hajime Takada actually dissented.
Yeah, Takada's dissent is one of the most interesting signals in global finance right now. He pushed for a hike to 1.0%, and his logic is brilliant, even if he was outvoted 8-1.
Walk us through his logic. I mean, if raising rates might crush a fragile economy dealing with an energy shock, why on earth did he want to hike?
Because Takada is looking past the immediate oil shock and focusing on the structural behavior of Japanese corporations. For decades, Japanese companies were heavily traumatized by the asset bubble burst of the early 90s.
They became what people call zombie companies, right?
Yeah, exactly. Zombie companies. They hoarded cash, they refused to borrow, they refused to invest, and they flat out refused to raise wages. Takada's argument is that despite the external chaos in the Middle East, that internal psychological trauma has finally healed.
Oh, I see.
Yeah, companies are actively borrowing again. They are investing in capital expenditures. He believes Japan is at a true dawn to finally exit decades of massive monetary easing and normalize their economy.
He essentially argued that if you wait for the perfect, calm moment to raise rates, you will be waiting forever. Because the world is inherently chaotic. You have to normalize when the internal mechanics are ready, regardless of the external weather.
Exactly. He wanted to rip the Band-Aid off. But the rest of the board was just too terrified of the Middle East contagion.
So we have central banks frozen, money remaining relatively expensive, and energy costs absolutely exploding. This collision creates a terrifying dynamic in a sector of the economy most people don't even know exists. The private credit market.
Oh, the private credit Jenga tower?
Yes. This is a $1.8 trillion market. And to understand the jeopardy here, we have to look at how this market functions mathematically.
Right. To understand private credit, you have to look back at the 2008 financial crisis. After the banks melted down, governments stepped in with massive regulations, things like Dodd-Frank in the U.S.
Right, telling banks they can't be so risky.
Exactly. They basically said to traditional banks, you cannot make highly risky, opaque loans to mid-sized corporations anymore. You have to hold more capital. You have to be safe.
But those mid-sized corporations still needed money to grow. They still needed loans.
Right. The demand for capital didn't disappear at all. The supplier just changed. A shadow banking system stepped into the void. Private equity firms, asset managers, and business development companies started lending directly to these corporations, completely bypassing traditional banks.
Which means it's outside a lot of the regulatory headlights.
It's a massive, relatively unregulated, and highly opaque market. And right now, we are seeing a staggering statistic. 40% of the private credit market currently has negative cash flow.
Okay, let's stop and really process that for you, the listener. Almost half of a $1.8 trillion market is bleeding cash. The companies that borrowed the money are spending more on operations and interest than they are bringing in through revenue.
It's terrifying.
How does a market even survive if 40% of it is functionally insolvent on a monthly basis?
Through incredibly aggressive financial engineering, specifically a mechanism called PIK debt, payment in kind.
Okay, let's break down the mechanics of PIK debt, because this is where the Jenga tower really starts to wobble.
Think about a traditional mortgage. You owe the bank $2,000 a month. If you lose your job and can't pay, you default, and the bank forecloses on your house. That's a transparent failure.
Painful, but transparent.
Right. Now imagine a PIK mortgage. You lose your job and tell the bank, hey, I can't pay the $2,000 this month. The bank says, no problem. We don't want to report a foreclosure on our balance sheet anyway. So just don't pay us in cash. Instead, we will take that $2,000 you owe us and we will just add it to the total principal of your loan.
So my debt just grows.
Yes. And next month, they charge you interest, not just on the original loan, but on the new higher principal. It is compounding debt.
That's insane.
It's the equivalent of paying your credit card bill with another credit card and the lender just pretending everything is perfectly fine because on paper, the loan hasn't officially defaulted.
That sounds like a ticking time bomb. I mean, it only works if you assume the borrower will eventually hit a massive windfall of cash to pay off the bloated principal down the road.
Exactly. It relies entirely on the assumption of massive future growth and cheaper refinancing rates. But look at what is happening on March 19, 2026. Oil prices have spiked, meaning operational costs for these companies are skyrocketing.
Right.
Simultaneously, interest rates refuse to go down because central banks are frozen by inflation. So the companies are burning through cash faster, their PIK debt is compounding at higher interest rates, and there is no cheap money coming to rescue them. The mathematical spiral becomes inescapable.
The Jenga blocks are actively being pulled out. And who is holding a massive amount of this opaque, expensive PI debt? The tech sector. Specifically, software companies and the firms trying to fund the massive, capital-intensive build-outs of AI data centers.
It's all connected.
It really is. The energy shock from the Middle East is violently colliding with the debt loads of the tech sector, creating what analysts are starting to call subprime tremors, highly reminiscent of 2008.
It is the ultimate irony of this specific moment in history. The physical infrastructure required to power the future is constrained by debt and energy shocks. But the software running on that infrastructure is attempting to break human constraints altogether.
And that perfectly leads us to track 2, the digital reality. While the physical economy is suffocating, the digital economy is undergoing an architectural revolution. The shift from AI as a tool to AI as an actor.
The agentic revolution.
Yes, the agentic revolution. We're looking at OpenAI's Frontier platform, which launched a month prior in February 2026. And we need to be very precise about terminology here, because this is not a chatbot. ChatGPT is a tool. You ask it a question, it gives you an answer, and it stops.
It waits for your next command.
Right. But Frontier is an ecosystem of AI coworkers. They act across enterprise systems, they have identities, they have corporate permissions, they execute multi-step plans without you holding their hand at all.
The autonomy is the defining feature here.
But let's look at this critically. If I am the chief information officer of a Fortune 500 company, why do I actually need Frontier? I mean, I already pay millions of dollars a year for Salesforce to manage my customer data. I pay ServiceNow to manage my IT ticketing. I pay Oracle for my supply chain management.
And they all have their own AI now.
Exactly. Every single one of those massive platforms is building their own internal AI. So isn't Frontier just adding another incredibly expensive, unnecessary layer of management on top of everything else?
That is exactly the debate that is currently tearing the enterprise software industry apart. To understand why OpenAI built Frontier, we have to look at the architecture of APIs and vendor silos.
Okay.
Let's say you use the AI embedded inside Salesforce. That AI is brilliant at navigating Salesforce data, but it's entirely blind to everything else. If you use the AI inside Service, now it's brilliant at closing IT tickets, but it doesn't know who your top customers are in Salesforce.
Because these software giants intentionally build walled gardens. They want you trapped in their ecosystem.
Precisely. They don't want to share. But think about how a real human employee works. A human doesn't just live in one application.
Right.
A sales operations manager might receive an email in Outlook, check a contract term in a legal PDF database,
Yep.
verify physical inventory in an SAP system, cross-reference customer purchasing history in Salesforce, and then generate an invoice.
They jump across a dozen different systems naturally.
Exactly. But if you have a bunch of isolated vendor-specific AI agents, they can't talk to each other. They don't share a common language. You end up with what Fidji Simo, OpenAI's CEO of applications, accurately described as silos on silos.
You essentially have to hire human managers just to coordinate the different AIs, which defeats the entire purpose of automation.
Exactly. And that is why Frontier is designed to be what they call a semantic layer. It sits above your existing systems.
Explain the mechanics of a semantic layer. How does it actually translate between these walled gardens?
It creates a shared business context. In software engineering, different databases define things differently. Oracle might define a customer using a 10-digit alphanumeric code. Salesforce might define a customer using an email address.
So they literally don't speak the same language.
Right. A semantic layer acts as a universal translator. It maps the ontology of your entire business. So an AI coworker running on Frontier doesn't care about the underlying code of Salesforce or Oracle. It just knows what a customer is conceptually.
That's wild.
You can log into Salesforce, pull the data, translate it, jump over to your inventory system, check the stock, and process a complex workflow from end to end, perfectly mimicking human interoperability.
And when you look at the deployment results from early 2026, the velocity is staggering. I mean, Uber, Thermo Fisher, global investment firms. There's an investment firm cited in the sources that used Frontier and saved 90% of their salespeople's administrative time.
90%.
Think about that margin. At a massive manufacturing company, these agents compressed a 6-week production optimization process, which used to require dozens of cross-departmental meetings into a single day.
When you remove the friction of moving data between human minds and software silos, the speed of execution approaches instantaneous. But this introduces a massive existential threat to the legacy software companies. It initiates the death of the seat license.
Oh, this is massive. Let's do the math on this because it fundamentally breaks Wall Street's valuation models for the entire tech sector. How does a company like Salesforce or Microsoft historically make money?
They charge per user.
Exactly. They charge a company per human user, a per-seat license. If you are a multinational corporation with 50,000 employees, you buy 50,000 licenses at, say, $150 a month each. That's $90 million a year in recurring revenue, just from one client.
It's the greatest business model in history.
Yeah.
Software as a service, or SaaS.
Right. But what happens when an AI agent managed by Frontier does the administrative work of 5,000 of those humans? You lay off or reallocate those 5,000 humans, and if you don't have those humans logging in every day, you don't renew their 5,000 seat licenses.
The math collapses.
Suddenly, Salesforce doesn't just lose a fraction of a client. Their entire revenue architecture begins to mathematically collapse. The software itself might still be useful, but the mechanism for monetizing it is destroyed by the AI layer sitting on top of it.
And the fear of AI agents making traditional SaaS invisible has caused absolute panic in Silicon Valley. We are seeing massive rushed pivots. Companies like ServiceNow are rushing to switch their entire business models to consumption-based pricing.
Like a utility bill.
Exactly. Like paying for water or electricity. Instead of charging per human, they want to charge based on how much compute power the AI consumes or how many individual tasks the API executes. They're trying to pivot from charging for access to charging for volume.
But the structural fear remains, right?
Yeah, oh, absolutely. Because whoever owns the intelligence layer sitting on top of the semantic layer ultimately controls the customer relationship.
And that leads us to the physical infrastructure required to run this intelligence and the massive legal brawl unfolding between big tech. Because while OpenAI makes the software has to live on physical servers.
It's not magic. It's hardware.
Exactly. And Microsoft is currently threatening a massive lawsuit over a $50 billion deal between Amazon and OpenAI. On the surface, it sounds like standard corporate posturing, but the mechanical stakes are astronomical. Why is Microsoft willing to go to war over Amazon offering OpenAI's Frontier to its customers?
It all comes down to the plumbing of the internet, specifically cloud computing. Years ago, when Microsoft made its initial multi-billion-dollar investments into OpenAI, they didn't just buy equity, they secured an exclusive cloud routing clause.
Oh, wow.
Microsoft essentially engineered a contract that said you can build the smartest AI in the world, you can sell it to anyone, but every single time someone uses it, the raw data must travel through Microsoft's Azure cloud servers.
It's a toll booth. They guaranteed themselves a monopoly on the infrastructure of intelligence.
A massively profitable toll booth. But look at Amazon Web Services, AWS. They're the biggest cloud provider in the world. They have massive enterprise clients who want to use Frontier. Amazon wants to hit a $600 billion revenue run rate.
Which is astronomical.
Right. And they want to offer Frontier directly to their enterprise customers natively within the AWS ecosystem. Because sending all that sensitive corporate data out of AWS over to Microsoft Azure and back again, it introduces latency, security risks, and most importantly, it gives Microsoft access to telemetry data about Amazon's customers.
So Amazon makes a $50 billion deal to host OpenAI models natively. And Microsoft points to the contract and says, "We will sue you into oblivion if you bypass our Azure routing."
The underlying war here isn't about the AI software itself. It's about data gravity. If Microsoft forces all AI traffic through Azure, they eventually force companies to move their core databases to Azure just to reduce latency.
Right, because data wants to be close to the compute.
Exactly. They are using OpenAI as a tractor beam to steal market share from AWS. It is a war for who controls the foundational compute layer where the autonomous economy actually lives.
So we have a physical world dealing with broken energy plumbing in the Middle East, and a digital world fighting over who controls the AI server plumbing in data centers. But this raises a profound logistical question.
How do they transact?
Yes. If we actually achieve this agentic revolution, if we have autonomous AI agents operating across global supply chains, instantly optimizing data centers, checking inventory, running investment firms, how do they actually pay for things?
How does an AI pay another AI for a service?
Exactly. An autonomous agent on the Frontier platform can't walk into a Chase Bank branch, show a driver's license, pass a KYC background check, and open a checking account.
Right.
The traditional banking system is built on human identity and T+2 settlement, meaning it takes 2 days for a transaction to actually clear. If the economy is going to be run by machines operating at the speed of light, those machines need a programmable, digitally native foundation for value transfer. They need money that works like code.
Which brings us to the regulatory watershed regarding the programmable economy. For over a decade, the crypto industry has been fighting a brutal existential war with the United States government. The core question was ontological. What exactly is a digital asset?
Right. Is it a security or is it a commodity?
Exactly. Is it a security, meaning it represents an investment contract in a common enterprise, making it subject to the massive compliance burdens of the SEC? Or is it a commodity, like gold or wheat, regulated by the CFTC?
And on March 17, 2026, just 2 days before the geopolitical chaos erupted, the U.S. government finally provided the answer. And it is a seismic shift. We are looking at a 68-page joint interpretation issued simultaneously by both the SEC and the CFTC.
Finally.
After years of interagency turf wars, they explicitly named 16 crypto assets as digital commodities, completely clearing them of being unregistered securities.
And we are talking about the heavyweights here. Bitcoin, Ether, Solana, XRP, Chainlink, Cardano, Avalanche, Polkadot. The significance of this document lies in its functional clarity regarding network activities.
Let's break down why this matters mechanically. And real quick, to you, the listener, I want to be absolutely clear. We are looking at legislative backdrops here, like the Clarity Act and the Genius Act. There is a massive political maneuvering behind this, but we are strictly reporting on the functional mechanics detailed in the source material. We are not endorsing any political side of this debate, left or right. We are just looking at how the technology functions now that the rules have changed.
Right. The politics are messy, but the math is what matters. Look at something like the Howey test, which is the 1940s Supreme Court case the SEC has used for decades to define a security.
It's super old.
Yeah. It basically says that if you invest money in a common enterprise with the expectation of profit derived from the efforts of others, it's a security. So how did the SEC previously view things like staking?
Well, for years, the SEC threatened that the act of staking, where users lock up their crypto to help secure a proof-of-stake network like Ethereum or Solana, might be an illegal securities offering. They argued you were relying on the efforts of others to generate a yield.
But this 68-page interpretation dismantles that completely. It officially classifies protocol mining, protocol staking, and even airdrops as administrative or ministerial activities.
Ministerial.
Yes. It acknowledges that securing a decentralized database is a mechanical function of the software. It is not a corporate investment contract.
So it provides the absolute safe harbor that institutional finance and big tech have been begging for.
And functionally, the immediate impact is the convergence of AI and crypto. Because of this SEC clarity, institutions can now build financial applications on these networks without fear of arbitrary enforcement actions. We see the immediate launch of the Tempo mainnet, and crucially something called the Machine Payments Protocol, or MPP,
Co-developed with Stripe, right?
co-developed with
The
Stripe.
Machine Payments Protocol. Let's dig into how this actually works, because this is the missing link for the AI agents we were just talking about.
Let's say an AI agent running on OpenAI's Frontier platform
Yeah.
is tasked with compiling a massive market research report. It needs to buy an hour of specialized server processing time from an Amazon data center, and it needs to scrape proprietary data from Bloomberg.
Okay.
In the legacy world, this requires corporate procurement, 30-day invoicing cycles, and human authorization.
It was way too slow.
Way too slow. With the machine payments protocol running on legally recognized digital commodities like Solana or stablecoins, that AI agent has a native digital wallet. It doesn't need a social security number. It can stream micropayments to the Amazon server continuously.
Wow.
Not a flat fee. It streams fractions of a cent, second by second, exactly matching its compute usage. If the AI stops needing the server, the payment stream stops instantly. Crypto is no longer a speculative casino for day traders. It has officially been integrated as the native, frictionless financial plumbing for the autonomous AI economy.
Okay, so we have autonomous AI agents running workflows, and they are natively paying each other in legally recognized digital commodities by the millisecond. The digital economy is fundamentally unleashed.
Right.
But if we connect this back to track one, the physical reality of March 19, if we have millions of AI agents constantly running, relentlessly demanding massive amounts of compute power from global data centers, and the world is simultaneously experiencing a massive oil and gas shock because the Middle East is burning, we have a fatal physics problem.
We do. We literally cannot generate enough electricity to run the intelligence we are creating. The current trajectory of classical computing, relying on standard silicon chips and massive, power-hungry data centers, is hitting a thermodynamic wall.
It just takes too much energy.
Too much energy and generating too much heat. To solve the energy crisis and the compute bottleneck simultaneously, we have to change the fundamental nature of computing itself. We have to move from manipulating bits of silicon to manipulating individual atoms.
Quantum computing.
Quantum computing.
And incredibly, on March 19th, 2026, the exact same day the global energy plumbing is attacked, we see quantum computing officially stepping out of the theoretical lab and into practical, real-world utility.
It's not science fiction anymore.
No, it's not. We are looking at announcements from NVIDIA's GTC 2026 conference. Let's start with the battery problem, because it connects directly to the energy crisis we talked about earlier. Xanadu, the University of Toronto, and the National Research Council of Canada announced a massive breakthrough. They figured out how to mathematically simulate something called RIXS.
RIXS, yeah. Resonant inelastic X-ray scattering.
For lithium-rich battery cathodes. Let's translate the mechanics of why that matters. Right now, if we want to build a better, more energy-dense battery to finally break our reliance on fossil fuels, the process is incredibly archaic.
It's basically trial and error.
Literally trial and error. Material scientists mix chemicals, build a physical prototype battery, charge it and discharge it 1,000 times, and physically cut it open to see how the atomic structure degraded. It takes years of physical iteration to make a 2% improvement.
And RIXS is the physical process used to study that degradation.
Yes. RIXS involves firing X-rays at a material to study its exact electronic and magnetic structure. The goal is to perfectly understand how the electrons in a lithium-rich cathode behave during charging. If we can map it perfectly, we can design a battery that never degrades and holds 10 times the power.
So what's the holdup?
The problem is, you cannot simulate that quantum mechanical interaction on a classical supercomputer.
Because classical computers calculate linearly. It's like trying to calculate the exact trajectory of every single drop of water in a hurricane simultaneously. The supercomputer runs out of memory instantly.
Exactly. The math of quantum mechanics requires a machine that speaks the same mathematical language as the atoms themselves. And what Xanadu proved is that they can simulate this RIXS process perfectly using fewer than 500 logical qubits.
And we really need to distinguish between physical qubits and logical qubits here. Because for the last decade, we've heard companies brag about having 1,000 or 5,000 qubits, but they were largely useless because they were so noisy.
Right. Explain the noise.
Well, a physical qubit is incredibly fragile. It operates using superposition and entanglement. But the slightest change in temperature, or a stray cosmic ray, or even ambient electromagnetic radiation, causes it to lose its quantum state.
Which ruins the calculation.
Exactly. That's called decoherence. It creates an error. To get around this, physicists use error correction. They group hundreds or even thousands of noisy physical qubits together to act as a single, perfectly stable, error-free logical qubit.
So hitting 500 logical qubits is a monumental engineering feat. It acts like a perfect digital wind tunnel for atomic structures. We no longer have to spend 5 years physically building and destroying batteries to see how they degrade. We can perfectly simulate the quantum interactions of the atoms in software in a matter of hours and design the ultimate battery mathematically.
Which fundamentally shifts the timeline of the global energy transition. It accelerates the timeline to independence from the Strait of Hormuz. But what is truly remarkable is how the tone of the conversation around quantum has
It
shifted.
used to be so skeptical.
For the last 10 years, the question was always, will quantum computing ever actually work? The announcements on March 19 show that the conversation is now, look at the impossible things it is doing right now.
Look at the announcement from Inflection. They hit a milestone using 12 logical qubits on their squale-neutral atom system. They aren't working on batteries. They are working on biomarker discovery and oncology.
Cancer research.
Yes, cancer research, part of the Welcome Leap Q4 Bio project. They use these 12 logical qubits to find hidden correlations in incredibly complex head and neck cancer data. We're talking about mapping patient DNA, RNA sequences, and complex pathology images simultaneously. And they found correlations that the absolute best classical supercomputers in the world completely missed.
Because a classical computer, even the fastest one on Earth, looks for patterns linearly, one after another, a quantum computer explores vast, multidimensional data spaces simultaneously. It can see the hidden topology of the data.
But we should clarify how they're actually running these machines, because the quantum purists thought we would eventually replace classical computers.
But we aren't throwing them away.
No. The architecture that is actually winning is quantum-centric supercomputing, hybrid systems.
Explain how the hybrid architecture works. How do a classical NVIDIA GPU and a quantum chip actually collaborate?
It goes back to that error correction you just discussed.
Right.
Qubits are fragile, and keeping them stable requires a massive, constant stream of highly complex calculations just to monitor the noise and correct it in real time.
Right.
If you ask the quantum chip to do its own error correction, it uses up all its processing power just trying to stay stable.
It's too busy surviving to actually do the math you want it to do.
Exactly. So companies are taking massive classical GPU clusters, specifically NVIDIA's Grace Hopper superchips, and wiring them directly into the control systems of the quantum refrigerators. The classical GPUs do the heavy, real-time linear math required to constantly correct the errors on the quantum chip.
They act as the life support system.
Exactly. They are the life support. This frees up the quantum chip to focus 100% of its power on the heavy atomic lifting simulating the cancer biomarkers or the battery cathodes. It is a perfect symbiosis of the old computing paradigm supporting the new one.
And that ability to map vast, multidimensional biological data spaces isn't just a theoretical win for computer science in a data center. We are seeing the immediate physical biological application of that kind of complex modeling right now.
Real-world application.
Yes, and it takes us from the quantum labs of North America straight to the clinical wards in Asia. Look at what is happening at Queen Mary Hospital in Hong Kong on this exact same day, March 19.
Hong Kong is acting as this fascinating geopolitical and clinical gateway, completely insulated from the energy chaos in the Middle East.
While the physical energy markets are burning, the machinery of clinical science continues to advance with precision.
We are looking at Racura Oncology, an ASX-listed biotech company. They just reached a massive clinical milestone, successfully completing the first cohort of their Phase 1 CPAX trial. The drug candidate they are testing is called RC220.
To understand why RC220 is a structural breakthrough in metabolic medicine, we have to look at the brutal mechanical reality of traditional cancer treatments.
They are rough on the body.
Incredibly rough. One of the most common, most effective chemotherapies in the world is doxorubicin. It is incredibly potent at killing tumors, but it comes with a horrific mechanical trade-off. It is highly cardiotoxic.
It literally destroys the heart.
Yes, doxorubicin induces severe oxidative stress on cardiomyocytes, the muscle cells of the heart. It essentially poisons the heart's ability to pump. You might successfully eradicate the patient's cancer, but you leave them with permanent, severe heart failure.
Which, I mean, defeats the entire purpose of saving their life.
Exactly. The brilliance of the RC220 candidate is its dual-action molecular design. It is engineered to perform two complex tasks simultaneously. It delivers powerful anti-cancer activity, ensuring the tumor is attacked, while concurrently providing active cardioprotection.
Cardioprotection.
Right. It chemically shields those cardiomyocytes from the toxic oxidative stress of the chemotherapy it is paired with.
And the clinical data coming out of Queen Mary Hospital is incredibly encouraging. The third patient in this Hong Kong trial was dosed safely at 40 milligrams per square meter. But here is the critical mechanical detail from the sources. 0 dose-limiting toxicities. And specifically, no phlebitis.
That is massive.
Yeah, for context, phlebitis is severe vein inflammation, which is a very common, very painful side effect when you are pumping harsh chemicals intravenously. The fact that the veins remain uninflamed at 40 milligrams is a massive signal of cellular safety.
So what does this actually mean for the architecture of the trial moving forward? Phase 1 trials are fundamentally about safety.
Right.
The goal is to find the maximum tolerated dose, the highest amount of the drug you can give a patient to kill the cancer without harming the healthy tissue. Because the safety profile at 40 milligrams is perfectly clean, it gives the Safety Review Committee a clear, mathematically sound path to aggressively escalate the dose.
They are preparing to double it, up to 80 milligrams per square meter in the next cohort. But what I find most fascinating about how Rocker is running this trial is their mathematical framework. They're using a Bayesian adaptive design.
Oh, this is so cool.
We have to dive into this because it mirrors the algorithmic leaps we were just talking about in AI. How does a Bayesian trial differ mathematically from a standard clinical trial?
Well, in a traditional frequentist clinical trial, you set rigid, unchangeable rules at the very beginning.
Yeah.
You say, we will test exactly 50 patients at 40 milligrams. We will not look at the data, and we will not change the dose until all 50 patients have completed the entire cycle.
Which seems incredibly inefficient. I mean, if the drug is highly toxic and hurting people, or if it's perfectly safe and you want to give them more to cure them faster, you are completely locked in by your own arbitrary sample size.
It's ethically and mechanically inefficient. A Bayesian adaptive design changes the math entirely. It is based on Bayesian probability, constantly updating your belief based on new evidence. You start with a prior probability based on your lab data.
Nice.
As soon as patient 1 finishes the dose safely, that data is instantly fed into this statistical model. The model updates the probability of safety for the next patient. When patient 3 finishes with 0 phlebitis, the mathematical risk margin shrinks drastically in real time.
So the algorithm calculates a 98% confidence interval that 40 milligrams is safe and immediately recommends the jump to 80 milligrams instead of forcing you to wait for 47 more patients.
Exactly. It is real-time algorithmic course correction applied to human biology. If the data shows early safety, the mathematical model allows researchers to adapt the trial faster, escalating doses quicker and moving closer to regulatory approval without ever compromising patient safety. It is the perfect integration of computational statistics and biological engineering.
It is the systems phase of medicine. We are no longer just blindly poisoning the body and hoping the cancer dies before the heart does. We are engineering dual action molecules, and we are using adaptive probability mathematics to test them at maximum velocity.
All happening right now.
It is happening right now concurrently with AI agents rewriting enterprise software and quantum computers simulating battery atoms.
Which brings us back to the core thesis of March 19, 2026.
Yes. Let's pull all of these massive threads together for you, the listener. When you look at the macro picture of this highly specific day, it's a perfect microcosm of human evolution at this exact precarious moment in history. Think about the physical legacy systems, the oil and gas refineries burning in the Middle East, the massive shipping bottlenecks in the Strait of Hormuz,
The frozen central banks.
the frozen central banks unable to manipulate their interest rate levers without causing a depression, the $1.8 trillion private credit markets suffocating under the math of compounding PI debt. The physical world is vulnerable, fragile, and actively breaking down.
But look at the technological and biological infrastructure. It is achieving radical, accelerating autonomy. We have AI agents on the Frontier platform utilizing semantic layers to run corporate workflows without human management. We have quantum algorithms flawlessly simulating atomic structures to build the next generation of batteries that will ultimately break our reliance on that vulnerable Middle Eastern oil. We have the SEC officially recognizing digital commodities, allowing AI agents to programmatically stream micropayments to one another without needing a legacy bank account. And we have clinical trials in Hong Kong using adaptive Bayesian math to safely advance targeted dual-action cancer therapies.
The physical world is constrained by the past, but the digital and biological worlds are compounding into the future.
The essential question you have to ask yourself as you look at these two tracks is this. What happens when they finally completely collide? What happens when the legacy systems we currently rely on, the central banks, the fossil fuel supply chains, the human-centric software companies, finally give way to the programmable autonomous systems we are building right now?
I want to leave you with one final, very tangible image to ponder long after this deep dive ends. Imagine a very near future. An autonomous AI agent working for a global energy cooperative uses a quantum-centric supercomputer to discover a perfectly efficient, completely new, energy-dense battery material.
Wow.
That same AI agent then natively pays for the manufacturing blueprints by streaming legally recognized digital commodities over a machine payment protocol. It then uses its semantic layer to coordinate the entire global supply chain across dozens of different software systems to start mass production.
And it does all of this in a matter of seconds.
In seconds, all while human central bankers are still sitting in a mahogany room, completely paralyzed, debating whether to raise or lower interest rates by 0.25%. Who or what is actually running the global economy at that point?
The old X-ray machine is definitely broken. We're looking at a completely different kind of anatomy now.
We absolutely are. Thank you so much for joining us on this deep dive. We hope we helped you map out this new anatomy, keep questioning the systems around you, keep looking beneath the surface, and keep exploring. We'll catch you next time.